But we are still in a earnings season, and therefore let's come back to earnings. We have got the Bank of Baroda numbers. Good on several accounts. It was good in terms of asset quality, good in terms of credit costs coming down, lower slippages, but growth is still niggling, disappointing. NII growth, and it was only other income that appears to have done well, treasury income. Joining us now is Sanjiv Chadha, Managing Director and CEO at Bank of Baroda. Good morning, Mr. Chadha. Thank you very much indeed for joining us. Great performance in terms of slippages being under control. Can you tell us, how things might pan out from here on? Are you seeing a significant fall in GNPA from here on?
So good morning, Lata, and a very good morning to all your viewers. So I think things have pretty much gone the way we thought would be appropriate in these circumstances. We have had a difficult last year or so, and we thought that it would be good to focus on a few things. One was to make sure that deposit growth and loan growth is aligned, so that you don't pick up deposits which you cannot place in the market by way of loans. Also keep a discipline in terms of the quality on both the asset and liability side. And we also had guided that we believe that the improving credit cycle, as far as corporate is concerned, will outweigh the concerns for MSME and retail. So I think things have panned out largely on those lines, and which is what is responsible for a fairly good set of numbers, both by way of operating profit and net profit. Growth has been a challenge, and that's something which is reflected in the broader economy. And it is at times good to trim your sails to see how the wind is blowing. But I do believe now, as we go forward, the growth momentum should pick up. For us, we have tried to do things where there were opportunities. For instance, our CASA ratio, we have moved it up by 400 basis points, which was a good thing to do in a liquidity surplus situation. And in loans, we have selectively grown where we had competencies and a USP. So for instance, our car loans have grown by 23%, personal loans have grown smartly. So I think strategy was, you might say, pretty specific to certain segments, but now I think a broad-based recovery is underway, and therefore, again, the bank can be more aggressive in terms of its growth.
Okay. Well, I am coming to growth in just a bit, but if you can tell me a little bit more about asset quality, have you provided entirely for the exposure to SRE, and what is the exposure to SRE?
So I think asset quality has been improving, and we have tried to, again, be reasonably aggressive with provisions, depending on what kind of accounts we have. With the NBFC, where there was a court stay, there's two things I think to appreciate there. So we have been making provisions on that NBFC, assuming it was really an NPA, and therefore there were provisions even for interest, which have now moved to the interest line. So the decline that you see in net interest margins is largely on account of that. Otherwise, our NIMs are pretty much stable. They would have been about 3% for both the Q1 and Q2, but for this line item moving up from provisions to interests. Now, going ahead, if we are looking at asset quality, I think the broad-based recovery that we have seen in the corporate credit cycle is likely to continue. And as we have said earlier, outweigh any challenges in terms of MSME and retail. But even in terms of MSME and retail, we have seen a big improvement. So our slippages in Q2 for MSME were half of that in Q1. Our slippages in retail in Q2 were 1/3 of Q1. So I think the pressure that was there on these two books has dissipated, while corporate continues to improve. Now, in terms of specific provision, we as of now are provided about 50% for this NBFC, which for the moment seems all right, given the prognosis for the company. But I think given what our exposure we have, I think we are fairly comfortable. And should there be a need to up that maybe by a small amount going ahead, I don't think that's an issue. But I think with 50% provided, we have most of our downside covered there.
Okay. Now, take your point, but nevertheless, people would want to know what may be your credit cost, your provisioning requirements going forward. Any guidance? You are at 1.42 now, right?
Yeah. So I think we had guided even the last quarter and the one before that we expect a credit cost to be between 1.5 and 2%, but trending towards 1.5% if things pan out the way we expect them to pan out. So we are keeping our guidance intact. We believe there are upsides to that.
Okay. Oh, that's good to hear. Okay, now let me come to net interest income and income itself. I take your point that, when you have to recognize something as a bad loan, the income recognition also goes away, and that has impacted. But nevertheless, it's a flat advances growth. Yes, retail has grown, but even that is 10%. I mean, see, the comparison would come from a much larger bank like SBI. With that kind of a base, they are doing a 7% overall credit growth and a 14%, I think, retail growth, if I'm not mistaken. Yours is not comparable.
Yeah, so I think that's a very fair point. I think there are some segments where we have outperformed the market. I think for the past very many quarters in car loans, we have grown nearly twice the market. Home loans, I think the growth has been muted, largely not because there were any issue in terms of disbursements or acquiring new customers, but we have very good quality customers. The interest rates have been going down, so banks have understandably been aggressive in terms of takeovers. Borrowers also would choose to migrate if they get a substantially lower rate. So I think that is what has muted growth. I think those are the pressures which are likely to go away as the liquidity situation normalizes. So I think I'm fairly sanguine in terms of our ability to grow not only the retail portfolio, but the overall loan book in line with the market.
In line with the market, now it is the last I saw in the WSS, the RBI supplement, it is 6.85. So you think you can do this year a 7% growth?
I would believe that we should be targeting growth between 7 to 10%. I think you need to take into account the fact that the first quarter, our corporate book had degrown by nearly 10% because, again, we had shed some low yielding assets. This quarter, Q on Q, our corporate book has grown 6%. So we are able to grow, we are able to underwrite good quality exposure. And I believe it is possible, particularly again with the liquidity situation normalizing, to actually have all the three imperatives covered: loan growth, underwriting quality, as well as margins.
Okay, that's good to hear. Now, just a word more on margins. Can they improve further?
I would believe so. I would believe so because, again, the margins that we have as of now are in a situation where liquidity was hugely abundant, and we were able to manage our margins largely by making sure that our deposit costs came down in line or better. So our net interest margin was 2.75% last year. It has moved up to 2.85 now, domestic, which is also understated because of the factor I laid out before you. So I do believe, again, improvement is possible along with loan growth.
Okay. Where's demand coming from? You have seen a little bit of corporate portfolio growth. Who's asking for money?
So I think there is a lot of brownfield expansion from the stronger players in the market. I think if you were to look at the capital investment that took place in the last cycle, it was very broad-based, and you might even argue indiscriminate. Now what you're seeing is it's the stronger players who have both the capacity to invest and also the wherewithal to see through market cycles who are investing. Brownfield expansion also comes on stream much faster. So I think that's what we are seeing. We are seeing that in cement, we are seeing that in steel, we are seeing that in green energy, we are seeing that in e-vehicles. Okay. That's called greenfield. Okay. And this is something which is, again, happening pretty quickly. Now, what we expect are a couple of other things to kick in. One is that with the busy season, the working capital utilization levels should be moving up. Apart from that, the PLI scheme also should kick off at least some capital investment there. And then if we believe that this economic recovery is likely to be sustained, which it is, in that case, capacity utilization should trigger a broad-based capital expansion cycle.
Okay. Yeah, actually, the US CPI rises like this, you may not have treasury gains, but that's another matter. Very quickly, a last question. Recoveries, what is the estimate for the rest of the year?
So we had a target of about 14,000 crores by recoveries for the year. We have done about 9,000 crores in the first half. There are no big recoveries of the sort that we saw in the first half coming up, but I think there's, again, a lot of pullback which is happening, a lot of recovery which is happening. So we believe we should be able to deliver on our guidance or better than that.
Okay. Well, we'll have to leave it at that, Mr. Chadha. So it does look like you have a lot of hope on Q4, both in terms of income growth, loan growth, as well as margins, and of course, much lower asset quality pressures. All the very best for what is left of the year. Okay, before we wrap up, let me get back to the most important macro